With countries in sub-Saharan Africa expected to be among the fastest growing economies in the world, China and Western nations are offering different paths to success. Hello, I'm Anand Naidu and this is The Heat. The needs in Africa are many, among them infrastructure, jobs and trade. Critics say the West has neglected the continent, either dismissing it as hopelessly mismanaged or simply engaging for its resources or security and defense advantages. Enter China. From a low of $10 billion in 2000, Beijing's trade with Africa reached $220 billion just 14 years later, making it the continent's largest trading partner. By contrast, trade between the United States and Africa has fallen from a high of $100 billion in 2008 to $39 billion last year. For more, we turn now to CGTN's Rama Inyang in Nairobi. And Rama laid out for us what's China's approach to trade and investment in Africa.
Indeed. So bilateral trade and development financing, those really are the two main avenues of engagement between the two sides. So often you've got raw materials, iron ore, oil, raw materials for metals, for example, leaving the continent and manufactured goods flowing in the opposite direction. But one only needs to look at, say, cell phone brands, for example, that are present across many an African market for a real-life example of how this trade flow works. The feature phone market, for example, that used to be dominated by Nokia for years. Today, though, it's Chinese brands, Huawei, ZTE, and Tecno that have practically cornered that market segment. Now, Transsion Holdings, which owns the Tecno brand, that shipped more handsets into Africa and the Middle East last year than Samsung and Apple combined. That should give you a sense of just how big this trade flow is. But the trade relationship, though, it's also changing quite a bit. You see, African economies used to have a trade surplus relative to China from around 2008, but now that's turned into a deficit of a few $1 billion between the middle of 2015 to May 2017. The thing is, though, as far as actual foreign direct investment into the continent is concerned, China's contribution, using official data, is pretty small. In 2015, according to analysis done by Brookings, China's FDI accounted for about 5% or so of the total FDI flow into the continent that year. There was a bit of a sharp peak in 2008, over $30 billion. Since then, though, it's been well under $15 billion a year, right up to 2015. Back to you, Anand.
Now, how does the Western approach compare to China's development model? Are the two competing, or are there opportunities for them to work together?
Indeed, we get this question quite a bit. The competition narrative is usually the easy one to tell and to frame, but the picture on the ground is a lot more nuanced than that. What Chinese development financing, what Chinese investment will do, and what its Western equivalent will do often are very, very different things. Take roads, rail, port construction, even energy. These are things that have been avoided by Western states for a fairly long time, decades even. And that has opened up the proverbial door for China and Chinese firms to pretty much walk right through. Take Kenya as a prime example of that sort of thing. The new standard gauge rail line, the new port that's being built in Lamu along the southeastern coast, that's all built and funded by Chinese money and Chinese firms. Now, as a result of that, China has vaulted into being the biggest or among the top 5 bilateral lenders for quite a few countries, and that has triggered concerns about debt concentration. Again, to use Kenya as an example, for the quarter ending in December, over 55% of Kenya's debt service costs went to just one country, and that was China. Now, at that point, the outstanding debt due to China was about as much as that due to the World Bank. So the World Bank and the IMF both have covered this extensively in the last 2 months. They've both raised the red flag of a debt sustainability in many countries. They're warned by their analysis, anywhere between 15 to 18 countries are at risk of high distress. And I can't stress this enough, the underlying irony here is that at a time when the infrastructure funding gap across the continent is much bigger, it's over $130 billion a year, African states have a much smaller capacity to absorb and service the debt funding that's needed to actually build that infrastructure. Back to you.
Thanks, Rama. That's CGTN's Rama Niang reporting from Nairobi. There is much to talk about. Let's get to our panel. Joining us from New York is Yinka Adeg-Oke. He's the Africa editor for Quartz, Atlantic Media's digital business news outlet. Whitney Schneidman served as the Deputy Assistant U.S. Secretary of State for African Affairs. He's currently the Senior International Advisor for Africa at Covington and Burling here in Washington. And joining us from Beijing is Chen Chen. She's the Deputy Director of Macroeconomics and a Research Fellow at Renmin University's Chongyang Institute for Financial Studies. Thanks to all of you for joining us. Let's start in Beijing with Chen. And Chen, let's look at the extent of China's involvement in Africa. China financed more than 3,000 infrastructure projects on the African continent. It's provided $86 billion in commercial loans, and President Xi Jinping has pledged a further $60 billion in additional loans. So how would you characterize China's involvement and approach to trade and investment in Africa?
I think it's quite prominent. One of the biggest features is that China combines its official development aids together with bilateral trade and investment. By ODA, official development aids, I mean the financing in infrastructure, because if you look at those projects, it's really difficult to make money in those projects. And Western economies, they feel quite reluctant to invest in those projects. But according to China's development experience, you need to get the roadways, the railways, and airways in place before you go through very fluent and facilitated investment and trade. So I would say now, after the One Belt and One Road initiative, we can see there's very positive interaction between those infrastructure projects and trade. So I would say that combination is one of the biggest prominent features, Anand.
Whitney, Chen made the point there that Western countries are reluctant to invest in Africa right now. If we look at some figures, in the last 9 years, trade between sub-Saharan Africa and the United States has declined by about 60%. Now, there have been critics who say that Western nations have neglected African countries while using its resources for security purposes. Is that a fair assessment?
I don't think so, really. I think when you look at the drop in trade between the U.S. and Africa, that's largely attributed to the fact that over the last 5-6 years, the U.S. has become self-sufficient in energy. A lot of our oil we used to import from Nigeria, Angola, Equatorial Guinea, like about 25%. We don't do that anymore. So that's really the main reason for the drop in trade. One other point to make, the U.S. is actually the largest investor in Africa, some $56 billion worth of investment stock. U.S. companies go back to we're in South Africa in the 1920s, GE, General Motors, Ford, other major companies. So the U.S. has a very strong history of investment, but it just has not been as sort of rapidly expanding, certainly as China and some other countries as of late.
But Whitney, is there recognition in the United States that when you look at Africa, this is a continent that's growing, it has a young population, it's going to become a huge market?
It is going to become a huge market, and it already is in many ways. But I think in the U.S. we struggle with perceptions of Africa. Many folks sort of see the African continent as a continent in the past of corruption and disease and conflict. They don't see it as a continent of opportunity and innovation and an emerging middle class. And I think that's what U.S. companies are waking up to. And they see a different Africa emerging, better governance, better infrastructure. And so I think the challenge for the U.S. is how to leverage U.S. resources in support of U.S. companies to make the investment wave stronger and broader.
All right, let me bring Yinka into this conversation. Yinka, there's been another kind of criticism of China's involvement in Africa. There's some critics who say that China's investment in Africa is neocolonialist, that it's exploitative. There's been accusations that China's been engaging in predatory lending, in land grabs. What do you make of that criticism?
I think what tends to happen here is the neocolonialist sort of narrative is kind of an emotive one, and one that doesn't necessarily take into account the agency of Africans themselves. these sort of arrangements, these agreements, whether they're loans, whether it's infrastructure investments, are done with our governments, and it depends on our leaders and our governments and the kind of arrangements they make with, be it a Chinese investor or a Chinese government state-owned enterprise. We need to be sure that our governments make arrangements that are in the interest of both sides of the arrangement. So the whole sort of very simple narrative that everything's just viewed through this sort of, because of Africa's recent history of the last sort of 200 years, is always sort of viewed through this sort of neocolonialist lens. But in actual fact, it is about our leadership making the right kind of arrangements that take into account this infrastructure that we need for development and that we need to create jobs. You make arrangements, you make agreements with your partners that that are not lopsided, that take into account these needs. For example, if you arrange a loan with someone to build roads, do you write into your agreement, yes, sure, we'd like to take this loan, but we'd probably pay 0.25% more interest if you can guarantee that you will employ locals to help create this road. So right. That needs to be a part of this story. It's not as simple as a neocolonialist narrative.
Right. And Yinka, to Whitney's point about there being a perception in countries like the United States, especially among investors, that Africa is ridden with corruption, that there's inefficiency there, that there's infrastructure lacking. Is it time for Africa to change that perception?
Yeah, this is exactly my point. It is totally up to us as Africans. We need the partners who have the advantages of capital, who have the advantages of expertise and knowledge to work together. Because it's in everyone's interest. China's Belt and Road Initiative, which I'm sure you'll come to, is passing through Africa, and it's to China's advantage. But it should also be to Africans' advantage as well, if we make this right sort of agreement, the right sort of partnerships. As for corruption, corruption is everywhere. It's not unique to Africa. But it's also not in China's interest to make bad arrangements with corrupt leadership, because right. at the end of the day, they also will lose in the long term. So, again, too simple to say just corruption, because corruption exists in many of these countries.
Right, and we will be talking about the Belt and Road Initiative in just a moment, but I want to get back to Chen. And Chen, I want to get your view on this criticism we hear of China's involvement in Africa, that China's being neocolonialist or exploitative.
I think just now Yinka touched upon very important points. I think the neocolonialism, the whole rhetoric is not about China. It's more about beautifying the traditional colonial history and to underestimate the independent will and independent decision-making by local African countries themselves. I don't think anyone wants to remember the very dark and brutal details of the colonial history. Back then, the international architecture is in an extremely inequality, and the colonial powers, they took millions and millions of African lives. I don't think there's any similarity with today's narrative. If you go through the projects nowadays that are going on in Africa, for example, the railway project we probably will touch upon very soon. Actually, the local governments and the Chinese governments, they go through rounds and rounds of negotiations before they finally decide to make a deal. So I think you can't underestimate the independent decision-making on both sides, both in China, both in Beijing and in local places. This is an independent and win-win scenario. Anand.
Whitney, you have nearly 40 years of experience working in sub-Saharan Africa. You helped create the Africa-China-US trilateral dialogue. Question is, Does the West and China have to compete in Africa, or are there areas where they can actually cooperate?
Well, it's a very good question because clearly there are areas where the U.S. and China are competing, but I think it would be a tremendous mistake to equate it with the Cold War. Today's competition is not a zero-sum proposition. I think there are certain areas where they compete over contracts, but the fact is that the opportunities in Africa are so large that there's space for everyone. But I think the point of cooperation is really where we need to move to. The work that we did on trilateralism that looks at how the U.S., China, and Africa can really cooperate to create an outcome that's good for Africa, I think has to be a priority. And I would just note that last week, a consortium was announced that included GE, Transnet from South Africa, and Sino-Hydro, which will rehabilitate the narrow gauge railroad in Nigeria. And this is quite an important development because I think where problems have arisen before, you had a clip of the standard gauge railroad in Kenya,
right,
which is an important artery. But I would ask the question, why was that project not put out to international tender? Why couldn't other U.S., British, other companies compete for that? Why was it sort of a closed deal? And I think the more daylight, the more sort of competition that we can get into the dynamic for infrastructure development, the better it will be for Africa.
And Yinka, if we look at the way Africa looks at this kind of investment, one criticism of Western involvement in Africa is that it places conditions on aid, and it interferes in many instances in the domestic politics of these countries, something that China avoids. And in that respect, does China have an advantage over the West?
Yeah, I guess you could call it an advantage. I am not, as an African, I am not totally against reasonable conditions. And what do we mean by conditions? If you're saying that we want transparency in this deal and we want to be open with it, that seems fair. I guess when it comes to getting into the politics of a country, it's a dangerous sort of path to go down. Just from purely on a sort of business transactional perspective. But yeah, it's too easy to say people are interfering if what you're trying to do is have transparent and clean deals. Like in the United States, they have the Foreign Corrupt Practices Act, right, to prevent that kind of thing happening with U.S. companies, for example. You do not want a situation. Take, for example, the problem that comes out of the lack of transparency in deals is the kind of thing where you hear stories about Chinese companies building infrastructure and a week later they collapse or something because someone has done some deal under a table. That may or may not be true, but the point is if there's no transparency in the first place, those kind of accusations become reality. People can make them, and they start to have some width of truth to them.
Chen, if we look at, broadly speaking, if we look at the Chinese investment, 40% of Chinese investment or loans go towards energy generation in Africa. Another 30% goes towards transport infrastructure. Is there a danger that China could be leaving behind a debt burden that many of these countries really can't service?
Yeah, that is...
Previously, there were indeed some of the problems, they were indeed existing. But if you look at the details, they were actually in accordance with the reality because you can't actually expect, take the infrastructure projects, for example, you can't really expect those local authorities or companies to truly pay back within a short period. But from the long-term perspective, now if you look at the AIIB, the Asian Infrastructure Investment Bank, if you look at their evaluation of local projects, they actually, along with the growth of local African economies, they are now, the evaluation process is much stricter. Before they decide to finance those projects, they need to go through the terms and make sure the local authorities or local companies are able to pay back after the construction projects were accomplished. So I would say that now it's more and more interactive. The interaction is more and more positive, and from the long-term perspective, as I have mentioned, that would definitely facilitate the bilateral trade and investment announced.
Yinka, I know you wanted to say something on this, but do you agree that safeguards have now put in place to make sure that countries can pay back the loans that are given to them?
Yeah, this is something on which again, it comes back to the Agency of African Governments and being responsible in the arrangements and the agreements they make with their Chinese partners. We've already seen there, if you look at Kenya, just as your reporter mentioned earlier, the last quarter they had 55% of their debt to one country, to China. I mean, this is not an unusual sort of situation. If some analysis has been done of the, again, to mention it a bit earlier, the Belt Road Initiative that comes through Djibouti, their debt is going to go up to about 89, 90%. And they haven't got the resources to service that. So it should be a sort of distress situation. So there are concerns that it still depends on the governments. I'm going to keep on stressing this. I don't so much think it's about China as much as it's about responsible financial management by the countries. But it's also up to China to analyze these things and perhaps say, I don't think you guys can handle this, if that's the case.
Yeah, and let me jump in there. I mean, you asked, have safeguards been put in place? And the short answer is no. I mean, you have to recognize we're dealing with 54 countries across the continent, 49 countries in sub-Saharan Africa, and every country deals with these issues differently. But what I'm concerned about is sort of what I see as a gathering storm of debt that's accumulating in Africa. And this is made up principally of two sources. One, African governments going to the Eurobond market and raising money and taking on debt from there. And then the second is China. China is responsible for about 14% of sub-Saharan Africa's debt. Right. That's a very big number. At the FOCAC in 2015, the China-Africa Summit, President Xi committed to making $60 billion of loans to Africa in 3 years. That's a lot of loans. That's $20 billion a year. So I am concerned that China's debt is mounting and could become a problem and begin to erode much of the really important good work that China has done in developing these more than 3,000 infrastructure projects.
Chen, what is your view on that?
I think one of the very important points that has been just touched upon is the transparency of information. Indeed, I think the Chinese government is also very well acknowledged of this existing problem. And if you look at what China did ever since the launching of the One Belt and One Road initiative, you can see that we are trying to improve the transparency of the information. So, I think back in 2016, China Bridge and Road Corporation has issued the very first social responsibility report. It tries to release the information to the public, what kind of, not just about the loans, but also about the ecological ecological environment protection, and also the establishment of the food security system. I think as long as we have enough information, the misconceptions will be less announced.
Whitney, I'm going to get something you wrote very recently, last month in fact, when you wrote that, and I'm quoting here, China's commercial presence on the continent will continue to grow, raising the principal concern that China's significant role in addressing Africa's infrastructure deficit could be offset by its contributions to a new and ultimately unsustainable African debt burden.
Right.
It's quite a mouthful, so
Right.
Unpack that for us.
Too long a sentence,
Yeah.
but just to pick up on Chen's very interesting point, I mean, it is true that there's a lot of information about China's activity in Africa, its lending practices. But the question is, to go back to your point, how do we put in those safeguards? What should those safeguards look like? If we go country by country, is it, a dialogue between the IMF, ministries of finance, Chinese government, to make sure that this debt can be managed and that we don't go through a situation that we went through 20 years ago when the West had to write off a lot of what was then official development assistance debt that was accumulated, because this is more commercial debt that's being accumulated, and it's going to be much more difficult to write that off, and I think it could become a real constraint on Africa's growth if it continues to mount.
Yinka, I want to get back to something you talked about earlier on, and that is the Belt and Road Initiative. That's China's Belt and Road Initiative. We looked at some facts here. The top 10 imports from Africa to China are raw materials. Do you see a point where China will become a major market for African manufactured goods?
Well, that is a hope. That at some point the governments of these countries or entrepreneurs in those countries build factories, and because the labor costs in China are on the rise, and they'll be lower in some countries in Africa. What's interesting about tying it to the Belt Road Initiative is the problem with many African countries, or the challenge, I should say, with many African countries, is not so much whether the cost of labor. It is that when you do the analysis, and I've seen several papers on this, read several reports on this, even if the individual cost of a worker is cheaper, the cost overall of producing products is too high in many countries because of the lack of roads and transport networks to really get the benefits of having a sort of lower, a cheaper workforce. So it's incredibly important that that these roads, these trains, these seaports are built and are developed, and that might, create a situation where African countries or factories or whatever are producing products that are being sold to China and vice versa.
Okay, and that's where we're going to have to leave it. Thanks to all of you for being with us. That's it for this edition of The Heat, but the conversation continues online. Join us on CGTN America's Facebook page to comment on this or any other show, or chat with us on Twitter at CGTN America. I'm Arun Naidu in Washington, D.C. Thanks for being with us.